It's plain and simple. Physical gold is the only globally accepted financial asset that can't be printed.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault. This is the show that goes beyond the headlines and uncovers the truth about the precious metals industry and the effects on the global economy in these historic times. We have exclusive access to experts and insiders, and we reveal information and insights that you simply won't find anywhere else. Hi, my name is Shane Morand, and I'll be your host for this week's episode of Live from the Vault, and we'll be joined very, very shortly by the one and only precious metals expert and whistleblower, Andrew Maguire, as we pull back the curtains on the intricate world of gold and silver, and we expose what's really going on in the precious metals industry. So get ready for another blockbuster episode of Live from the Vault, and we'll bring you the knowledge and the understanding that the mainstream media just won't be able to provide. So just before we head over to the UK, please help spread this word, and you know how. It really helps the channel when you hit that like button. It helps the channel when you share the information, and even if you haven't already subscribed, you need to do that. Now, if you subscribe and you hit on that bell right there, you'll be notified as each episode goes live. And with that, let's head over to the UK and talking gold with Andrew Maguire. Hey, Andy, it's good to be with you. And man, maybe you could tell us about your studio. What's happening? A new look.
Nice to be with you again, Shane. And of course, with all our very loyal, very, very special subscribers. And I just wanted to say, guys, look, and welcome to our new Kinesis studio. And this is timely because we're moving into 2024, and 2024 is going to be a big, big year. So we're gearing up for it now.
All right, Andrew, looking sharp there. You know, so much has happened since our last market update, and I can't believe it's been already 2 weeks ago already. We're now recording this episode with just 1 day before the end of November. And in our last episode, you really highlighted how the speculators were on the wrong side of the market once again, and the opportunities that really presented us. Now, following the predicted physically driven upside breakout, can you tell us what you're seeing right now?
Yeah, guys, this is a timely episode, setting up the end of the year trade leading into the inevitable central bank driven gold price reset that we've been forewarning about. And during 2023, the gold price reset has been delayed for one reason only. The Fed tried to push back against a physically driven global price rally, making the mistake of selling paper gold in a failing attempt to cap the dollar price of gold. However, with gold as benchmarked in every single other currency rising to all-time highs during the whole of 2023, and the fact that gold trades as a very liquid foreign exchange currency cross against all the major global currencies, the arbitrage opportunities for global central banks and sovereigns to exchange their depreciating dollars for dollar-denominated gold into a shrinking global supply of physical gold has caught the Fed really extremely wrong-footed. And as we've been drawing attention to, the paper-to-physical imbalance at current unbacked fiat prices has put the Fed in a position they will have to capitulate their capping efforts. And let's explain that, and because it defies logic that the Fed insiders could possibly have ended up holding such a massive losing hand, especially for those that really still mistakenly perceive that the Fed is actually a government organization versus the cabal of self-serving private banks really calling the shots. Let's look at how and why the Fed got into such an untenable position against every other central bank, and why they will have to fold their paper gold cars. And this leads us to the subject, really the real subject of this episode. The upcoming gold price reset, which we see gold being supported versus being capped. The implications are immense. And what we will now look at is the effect the central bank driven gold price reset will have, what that's going to have on really the gold and silver derivative markets. Now, given the Bank of International Settlements covered all 500 tons of their gold swaps 1 year ago in November, alongside every other central bank during 2023 having covered their own gold derivative positions at the expense of the Fed, and in anticipation of the Fed being forced to also be Basel III compliant, global central banks have been accumulating physical gold ahead of an inevitable gold price revaluation. Now, what is lost by many COMEX bubble market traders is that the moment the BIS covered all its gold derivative bets at $1,618 1 year ago, they and every single other central bank that has been coattailing the BIS have been rewarded with well over a $400 per ounce higher gold price. Think about that in tonnage size. But there's always two sides to every trade. The Fed has been left holding the bag, while every other central bank will now benefit from a higher gold price to offset their depreciating dollars, their pounds, their euros, their yens, their rubles, etc., etc. So Shane, let's step into the real world outside the Fed's tentacles and share what we, along with our first-tier liquidity providers, are actually seeing. And with global central banks, bank buying having really put a floor, a real solid physical floor under the a stair step higher, basically. We were talking about these stair steps are building, and forget the short-term rinses. These stair steps are unmistakable, and they're creating a support level under the gold market, and that's happened during the course of 2023, despite Fed's best efforts. And we've evidenced gold breaking out from its historical algorithm-driven inverse correlations during periods of dollar strength. We've drawn attention to this, and especially into rising real yields. This was the primary hegemon's intervention tool relied on to cap gold rising against the dollar, and it is irretrievably broken.
Hey, Andrew, I went back and listened to the first episode of Live from the Vault way back in January of 2023. And our, community can do the same. But you made it absolutely clear. We've talked about this before, but you've made it clear that because gold had just been revalued as a first-tier asset class, prior to that, it wasn't. Now it was revalued. And you said by the 2023 year end, which is now, basically coming up to 2023 year end, a physically driven gold price would begin to emerge from the legacy paper market. So this looks like to be playing out exactly as year end. What are you seeing, Andrew?
Absolutely, Shane. And as we've been drawing attention to ever since, despite every single tool to cap gold being employed, this bullish gold behavior during 2023 is directly attributable to first-tier gold seriously competing with US treasuries. And while it took until the third quarter before we evidenced institutional traders actually seeking real assets so as to hedge against an out-of-control Fed, concatenating with a series of black swan events, none of which are really even yet factored into the current price of gold and related silver. Now, with 2023 coming to a close in just 20 trading sessions, it's a good idea to step through the largely unreported reasons as to why gold is going to have to be revalued as we enter 2024. And the huge opportunity this presents long-suffering victims of cartel-driven gold price suppression. Hey, you stackers, no worries, you've been building all along. But while the house insiders are planning for this event, not so for the speculator patsies, unaware of the approaching gaping derivative chasm. And just as we entered the game-changing Basel III NSFR conditions imposed at the open of gold trading in 2023, morphing physical gold into a first-tier asset class, under the synthetic market participants' noses, gold began to compete with US treasuries. Now, the same blinkered, led by the nose COMEX-centric speculators are about to enter 2024 trading completely oblivious to the upside gold price revaluation risks that threaten the very existence of the only non-NSFR compliant market they are deliberately constrained to operate in, the COMEX casino. And we've always kept an eye on how many speculators have been led by the nose to be subjected to the regular Fed-controlled wash and rinse cycles that we've been drawing attention to. But an increasing number of these speculators have become sticky and unable to be rinsed. And we've been really drawing a lot of attention to why that is. And with bonds increasingly being viewed by commodity trading advisors, the professionals, as an unreliable hedge for risk assets into a Fed, because while the Fed is spinning higher for longer, this mantra really creates an unreliable hedging situation. Gold is seriously competing with bonds as an asset class, severely dislocating long-standing historical correlations. And this will make CTA COMEX longs increasingly sticky, reducing the fuel to trigger the officially driven downside gap close attempts, which we have seen multiple attempts of in 2023. Now, the revaluation drivers are now front and center as we enter 2024 trading, and even putting the grossly out of kilter physical supply-demand imbalances aside for the moment, as we previously highlighted, as a result of an out-of-control reactive Fed, every single Western global central bank is operating at a loss as unfactored, steeply higher interest rates have been driving bond yields into unfactored highs, with the realization that the interest cost on fresh bond issuances has now become the single largest government outlay. Hardly an equitable situation. And as we reported last time, in order to just maintain the status quo, the Fed alone has to issue a minimum of 1.784 trillion of newly issued treasuries in 2024. But as we've been drawing attention to, Goldman, amongst others, and Goldman is a strong ally of the BIS, began openly questioning if there would be sufficient buyers of this fresh debt issuance. And given that the physical gold provides global central banks and sovereigns and institutions an alternative zero risk liquid alternative to high risk treasuries, which relies solely on faith, it is no surprise we are evidencing the largest reported central bank gold buying alongside such even larger unreported monetary gold purchases during 2023. Off the scale. And it's plain and simple. Physical gold is the only globally accepted financial asset that can't be printed. And these unprecedented central bank gold accumulations that we've been witnessing since the BIS covered all of its gold derivative positions 1 year ago in November, remember, over $400 lower at 1618 is where they finally covered. These institutionally driven real asset accumulations are in preparation to revalue gold, just as US Treasury supply meets buyer resistance. Now, to answer some very, very focused subscriber questions on the economic effects of a gold price reset, these freshly bolstered gold revaluation accounts will provide global central banks the ability to recapitalize Treasury accounts and to square up public debt.
Hey, Andrew, how do you see things playing out here?
These gold price revaluations will likely roll out alongside quantitative easing, further driving the gold price higher, and it will be a necessary component of squaring government bonds, in turn driving the gold price support levels well above the estimated plus minus 2,000 gold revaluation point. We think that will be the level where the revaluation will happen. And following a revaluation, it will benefit central banks to seek a stable, higher gold price against their respective currencies. Now, gold in every other foreign exchange currency has taken out prior highs during 2023. So everyone's been focusing on the dollar. But look at the bigger global picture and you'll see that the gold has risen everywhere. So the only question is, how will the dollar-denominated gold price revaluation impact the only remaining non-NSFR-compliant global gold exchange, the COMEX? Now, there's a ton of questions about this. And based upon the established house structure, unbacked short COMEX futures positions really are the accepted mechanism for hedging asymmetric gold and silver structures, as well as the tool, of course, to naked short, after being chart painted, these synthetic structures. And therein lays the problem for the speculators, who are being set up as the patsies into an unfactored central bank driven gold price revaluation, which, depending on which of the revaluation sequences, and we'll look at those as they roll out, we'll look at those. And obviously, until the dust settles, it will enormously widen the COMEX bid-ask spreads as established algo-driven pricing models relying on really the legacy paper market liquidity seizes up. The paper market liquidity will just not be sufficient. And while differing from the $100 bid-ask spreads that we evidenced after COVID shuttered the refineries back in March 2020, that forced the physical on offer to dry up to a bid-only market, there are two drivers that could set up a disruptive bid-ask price dislocation again. The first one relates directly to the 10 times larger than COMEX over-the-counter foreign exchange markets. Now, while first-tier market-making insiders providing liquidity to the over-the-counter FX gold markets are one-to-one Basel III NSFR compliant and will be fully geared up for such a physically driven gold revaluation announcement, there are some second and third tier liquidity providers alongside higher risk institutional traders who are still reported to be leveraging their fully backed over-the-counter physical holdings with very lopsided leveraged short COMEX bets. In other words, they've leveraged them. Now, these aggressive structures rely on the status quo to be able to square off any unwanted delivery exposure, so that they can actually, really box off billions of largely options-related derivative bets before they're alchemized into the physical they don't own. This is what's been happening. However, into a bid-only market, they'll be forced to buy back these leveraged shorts for a loss and or to deliver the underlying physical underpinning these leveraged synthetic bets. That will cause a problem. And the second concurrent derivative issue would be uncovered inside the leveraged COMEX futures exchange. And as we'll look at, very much depends on whether the revaluation is coordinated or weaponized. And we'll drill into that in a second, but either way, naked COMEX short speculators will be vaporized. Stops into a bid-only market will be useless, and successive triggered house margin calls could be severe enough to take down some brokers. Look at that in a minute. Be careful here. These brokers are relying on the status quo, allowing specs to take on massive naked short options, put or call structures. And as far as the better structured professional commodity trading advisors are concerned, the problem for these traders is that they too they're locked inside the siloed COMEX and they're unable to offset leverage bets. They're unable to use their branded casino chips outside the house structure, meaning they'll have to accept the house exit terms. However, onerous problem, really, however onerous these structures are presented to them. And the problem is that this group of largely professional commodity trading advisors, the problem is they issue long fractionally held gold warrants to back up leveraged COMEX shorts. Now think about that for a sec. The issue is that both sides of these house trades are highly leveraged. And as can be evidenced in the weekly COT reports, we sometimes look at these traders are in a constant state of one side or another of a house generated synthetic wash and rinse cycle, the house regularly catching them imbalanced, whereas outside the casino, a predatory central bank or a first-tier liquidity provider straddling the COMEX and the over-the-counter markets can backdoor. We talked about EFP mechanisms before, which is the backdoor to the COMEX. They can backdoor EFP COMEX bonds into a deliverable, fully compliant, NSFR compliant spot over-the-counter position, which, because it's physical at the margin, it will disrupt the so-called balance by forcing the physical delivery of leveraged COMEX warrants. Now, liquidity providers assess that the COMEX futures exchange cannot be seen to default on its EFP mechanism, as it really directly relates to the squaring of billions of dollars of synthetically squared. We talked about the GLD ETF. The GLD ETF has a fractionally held. Remember, we talked about it's the illusion of the illusionary exchange. There's so much coming in and out. There's a big flywheel there, and the potential is for an unbacked position. So really be careful if you're a GLD ETF investor. These positions are non-Basel III compliant. So something we've been drawing attention to recently is the GLD ETF is the Fed's Achilles heel, and it is already under attack by competing central banks taking advantage of this discounted loophole.
Hey, Andrew, we've had some questions on how the COMEX will deal with this sudden gold and silver price revaluation. Can you refresh our new subscribers and our new community members as to how this may play out?
Yes, Shane, really glad to. And to add a little color, the COMEX prepared to defend such an event all the way back. This was after the presidential meeting of the too big to fail bullion banks back in 2013. And this is when the CME gold market price limit halts were implemented. Namely, you've got the 5-minute halts for futures and a 3-minute halt for options. However, while the COMEX traders are captive to these circuit breaker halts, the 10 times larger over-the-counter compliant and SFR compliant over-the-counter FX gold markets are not frozen, providing the same CME LBMA market makers privileged to secure a foot in each market the ability to position long through these COMEX halts into a bid-only foreign exchange gold market. Now, the scope of being able to do this is actually constrained to the degree they can secure enough physical to actually back those positions up, which ironically further forces the offer to sell physical gold to dry up, exacerbating this condition. And it's important to understand the mechanics of this. So to sum up, into a 5-minute COMEX market halt, the 10 times larger spot gold market will continue to go bid only, and every subsequent CME market reopen will be followed by another halt. Clearly, it's a bid-only market with initial bid-ask disruptions. They won't be dissimilar to when the bid to cover COMEX shorts went bid-only back in March 2020. But dissimilar because this time it won't need to be resolved by way of a too big to fail bailout, because these insiders are now NSFR compliant and will be physically backed. And while the agent banks acting on behalf of the Fed will be made good by way of a Fed gold price revaluation, a real market equilibrium price will only be resolved once the offer price to sell physical gold matches real demand. And this will clearly be significantly higher than where gold is initially benchmarked by central banks revaluing gold, say at 2000. So let's look at what scenarios the oblivious COMEX speculators will encounter as soon as the first global central bank announces they have actioned their gold revaluation account. Now, bear in mind, a central bank revaluation can be actioned without notice, with the central bank simply selling existing gold reserves and then immediately rebuying them back at market, which is in effect simply a book entry that capitalizes on the price difference. Therefore, no warning is likely to be issued. And while these pre-valuation global central bank currents stand-in carry costs vary enormously, right now they're all well below the current market price. And in the aggregate, liquidity providers, a tough thing to guess, but in aggregate, liquidity providers access at best estimate maybe at around $800 an ounce. However, in the case of the Fed, Treasury gold is currently valued at $42.22 per troy ounce. Now, the moment a gold price revaluation is actioned by any one Western or global South Central Bank, such as illustrated by the pragmatic recent rumblings emanating out of the Dutch Central Bank discussing such a revaluation, and that was great work by Jan Nieuwenhuis on translating their minutes. This will be conducted with the BIS already long, unencumbered gold site gold accounts, and while there will be an insider known timeline for the gold price reset, as is the case with every central bank insider action, it won't necessarily be shared ahead of time in the general marketplace. Why would it be? And as we outlined in several recent episodes, gold is a multi-trillion-dollar liquid FX currency cross. So the moment any one of the global central banks, when they do revalue, to avert a foreign exchange currency imbalance, they'll all have to coordinate. And the Fed is not stupid. And for the rehypothecation reasons that we've outlined in real detail in recent episodes, they will have too much at stake to not also coordinate revaluing gold. And from this point onwards, it will benefit every global central bank to support the price of gold versus the agreed percentage of GDP in each jurisdiction. And it'll be a formula which they'll agree.
Hey, Andrew, you mentioned these revaluations could be coordinated and even weaponized. Can you outline what you think and how you think this is going to play out moving forward?
Yes, Shane. In a Western coordinated revaluation, the gold price reset will most likely reset over a weekend, using the closing Friday price as the benchmark for marking all derivative gold to that closing market price. Then, at the open of trade on Monday morning, an SFR-compliant deliverable FX spot gold will evidence a significantly higher opening price. And we'll look at how this scenario plays out shortly, as it will somewhat differ from how a weaponized global South revaluation rolls out. And if the gold price revaluation is hostile, though, which could be the case in any number of geopolitically driven scenarios, such as if the Sino-Russia alliance were to push back against US-driven fresh sanctions, or as was indicated by our well-connected Chinese contacts, observing China's military complex readying for a potential offensive pushback against the extremely large US naval presence around the South China Sea. There are so many potential triggers. And while the implication of a wider escalation are not being discussed by the mainstream media, this next few weeks evidences the closest East-West military encounter in modern history. And given the very poor US-China relations following the reaffirmed dictator comments, could easily force a Taiwan saber-rattling confrontation. Also, if the US risk markets are anything to go by, none of these drivers point to any real geopolitical risks really escalating. It's completely ignored and ultimately threatening potential. There's a threat of a potential Middle East war. And while we largely discount that the two major powers, the US and the Sino-Russia industrial military complexes, directly go to war with each other, none of these events can be discounted. And Xi's art of war non-nuclear solution would be to simply weaponize a gold price revaluation surgically timed as a warning shot against the Fed's across the Fed's bow. In a weaponized revaluation case, the gold price revaluation would likely be triggered in the early hours of a London morning trading session while the Asian session is open. In either case, as far as the COMEX speculator is concerned, anyone short gold or silver COMEX futures or their related options, even if it's part of a legacy asymmetric COMEX hedging structure, or if they're leveraged against a physically backed NSFR compliant spot gold contract underpinning a larger leveraged COMEX short structure, these naked short imbalance structures will be decimated. Bottom line, any and all COMEX shorts will become a problem to cover as the bid-ask spread to cover will widen to unknown levels and margin calls will abound. And while the bid-ask fracture will differ from how the March 2020 contract broke the COMEX market, it will be for the sole reason that the first-tier liquidity providers, even those who are not inside the information loop, are this time now fully Basel III NSFR compliant and do have the bullion to put on offer to deliver. This will negate the need to cover fully one-to-one hedge short hedging bets, and not so though the leveraged COMEX specs who have no ability to hedge COMEX shorts with NSFR compliant gold.
Andrew, how do you see this impacting the COMEX speculators?
Global liquidity providers really assess that the COMEX cannot afford to default or even call a force majeure on a foreign exchange cross, because it would be the final death knell for all other contracts trading on the CME exchanges. A force majeure can be called in the event of unforeseeable circumstances and prevent someone fulfilling a contract. This may apply to other commodities, but it is impossible to legitimately call such an unforeseen circumstances in a monetary metal, as unlike all other commodities, futures contracts, gold and silver, are concurrently also traded and can be directly EFP'd into an NSFR compliant foreign exchange cross. And in the past, we've studied how the March 23rd, 2020 Black Swan event, we looked at it in detail. But in summary, the massive dislocation between the paper and physical markets triggered the event that broke the all-important paper-to-physical EFP conduit. First time it was exposed, and they were bailed out. And therein lays the problem in calling a force majeure in gold or silver. In 2020, officials stepped in to bail out the bullion bank, liquidity providers. This time, every insider will be on the right side of the revaluation process. Not so the specs, who will be hung out to dry. And as far as the specs are concerned, in both scenarios, those long will probably be able to ride the price higher into a bid-only market. Why would you sell? And while those on balance betting naked short, in other words, those traders who've borrowed gold from the house to sell it and have sold it, they're going to be caught in the CME ringer. And we've previously looked at this CME rule in granular detail, but in summary, whether the gold price is coordinated and opens up on a Monday at a higher price, or if it's weaponized, driven higher in early London, in an early London blindside move, both scenarios will be sufficient to trigger the special CME rule, which is a series of market halts that will freeze COMEX trading, after which each subsequent open will result in another bid-only successive COMEX halt until it is resolved. And the 10 times larger Basel III compliant gold and non-NSFR compliant silver spot FX market will not be frozen and will be tradable. But to be clear, while liquidity will also thin out in the spot FX markets, which would block a lot of second and third tier liquidity providers, the market-making liquidity providers will seamlessly trade for their own book. This is a very, very unfair structure. Ultimately, this whole gold price reset process will be insider coordinated and brutal on gold or silver future short sellers, subjected to these successive series of 5-minute market trading halts and 3-minute in your options into a bid-only market. This is why we assess naked short specs are dangerously wrong-footed as we enter the end of 2023 trading. So really, to sum it up, in the very short term, the consolidative action in both gold and silver has been really constructive this year, evidencing really decent backfilling of upside gaps, then filling them up again and creating stair steps, leaving far fewer downside gaps to fill on rigged news beats or insider known news beats or even dollar index rallies.
All right, now, Andy, how does silver figure into the gold price reset?
Great question, Shane. And this presents quite the opportunity for stackers. To best expose what we're currently experiencing in the paper-driven markets, where everyone wants to get on board at the same time into a price rise, and everyone wants out on a price decline, this synthetically driven action completely marks the real physical market supply-demand fundamentals. Hence, we focus on the various actors' footprints in the much more transparent wholesale silver market. Unlike gold, silver is not NSFR compliant yet. So in order to track the insiders' footprints pitched against the speculators and to best assess what to expect in harder to read gold, we need to look at the massive options derivative structures, which when weighed against the wholesale market footprints provide a really good view into the insiders' footprints. Because when we net out the sweet spots, where we look at the sweet spots, they're usually very accurate and provide a small window into the multi-billion-dollar related over-the-counter markets. You have to offset one with the other. Now, we're recording this episode on Wednesday, the 29th. As of last Friday, digging beneath the plain vanilla option structures, which at face value suggested the usual suspects were really fighting to cap the call structures into options expiries on Monday, and I'll explain how those work in a sec. These same actors' footprints in silver revealed it's the specs who'd been betting that $24 calls would be finishing out of the money on Monday. Meaning bulls were being set up and rigged into losing their long silver investment bets above $24, with the specs keeping these neutralized bets. That backfired. In fact, it was the specs who were also aggressively betting against $23 finishing out of the money. And it was the realization that these bets were wrong-footed, exposing them to potentially unlimited losses, that commenced the silver short squeeze last Friday. And that's where it's commenced. These capitulations have successively been triggered by broker margin calls on these speculators. And it has to be borne in mind that selling unhedged naked short calls, write this call, exposes the seller, which is the writer of this contract, to unlimited losses, far in excess of the premiums credited to their accounts at the time that these calls were initially written. Now, huge profits can be made as an options writer. However, if they get it wrong, and given paper-centric COMEX speculators have no visibility into the wholesale physical markets versus the market-making pit managers who are exposed to the wholesale physical markets, they do. It is the house who is surgically on the long side of these spec bets. And it is the speculator options writers who are prone to being wheeled out of the casino feet first. And at best estimate, these bets against silver have accrued over a 12-month period. I mean, just again, the status quo, everything's fine. Look at the chart, go back a bit. Yeah, it's all well capped. So make a bet that it won't rise. They did that at $22 too, which very much like the March through July 24 calls that are currently being written right now, because the December contract just expired. It's going into first notice today, actually. And now we see the sellers saying, well, I'll tell you what, let's sell March, the next liquid contract, which is March in silver. Let's bet that it won't go above a certain price. Well, what they did before and what they're trying to capture is the time element of that bet, the theta. But they were on balance. They were in December. They were on balance deeply underwater anywhere above $23. Worse, on a pit close above $25, which is currently front month March futures is 25.42, there is going to be all hell to play. This really could trigger a rally into the 35s. And while it's benefited the market makers to historically keep these useful fools, speculators, from being fully rinsed, so as to keep them just in the game to prolong the very profitable and carefully managed casino game, you've got to allow 5% to win and the house can profit 95%, and there's just enough there to keep them in the game. It is the swap dealer commercials who ultimately stand to profit from a speculator default, and they are well prepared. The footprints tell us so. So we look to be approaching this rare event where the physical market forces a massive short squeeze, such as not seen since silver blew through speculator short bets against $20 back in August of 2010. Now, the white circle that we've drawn on the chart in 2010 is in this stripped down chart illustrates exactly what we're talking about here. This spec short squeeze resulted in an almost, as you can see, an almost uninterrupted 2.5-year rally through to $50, and ultimately resulted in the bankruptcy of broker MFG Global in 2011. So large was MFG's derivative speculator exposure, it resulted in the 8th largest bankruptcy in the history of the United States at that time. So please get it in writing from your broker. Your funds are segregated. You need to know that. You need it in writing. So looking at the same actors in gold, because it's the same actors. So really, silver gives us that transparency. The structures is actually slightly different, as we also have evidence the Fed induced political capping at $2,000 for quite some time. However, similarly, we also see specs coattailing these official bets, which due to leverage involved also exposes gold futures to a similar short squeeze, not seen since a physically driven rally in 2008 drove a 3-year $1,300 paper market short squeeze from bets against $700 gold capitulated into the 1900s in 2011. Now, this stripped down chart here, look at the blue circle at 2008. That is what we're talking about. This is the kind of potential setup. That was a short squeeze. So as we get closer to the end of the year, we see the Fed doing the utmost to lay the shorts onto the specs in an attempt to cap 2000. But given every single central bank other than the Fed is long physical gold, and we now start to focus on a massive imbalance between the paper market and the tight undersupplied physical market at current prices, that is, we see a strong end of year rally really getting some legs. And if not before, probably after non-farm payrolls next Friday on the 8th of December. Now, the paper to physical reset is at last beginning to go mainstream. And after this current short squeeze rinse, calls for a revaluation are getting the attention of the technical short sellers who have been recently enjoyed sufficient COMEX-centric position concentration of the COMEX open interest, the chips, as we say. Been enough of them there floating around to be able to ignore real supply-demand imbalances. Well, this is all about shining a light into the CME LBMA rabbit warren. So when you make a decision, you are better informed. Just remember, this is more about wealth preservation than making money. We have the power. Every single physical ounce of gold and silver we remove from the dwindling physical stockpile undermines the cartel's game. And given they are gearing up for higher gold prices, are you guys?
All right. Thank you, Andrew Maguire, for another amazing episode of Talking Gold. And just a reminder, or actually a notice, that next week or next episode, we're going to be doing a new segment and we're going to be taking questions from you. You know, your questions, I'm going to be asking Andy on behalf of you. So fire off your questions in the comments down right below there. Start doing that. And we're going to get the best of the best questions. And remember, to our Live from the Vault community, buy physical, make sure it's backed 1-to-1, physical, and understand the difference between what Andy affectionately calls the casino paper, gold, and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled. And there you have it. That's all we have for you today on another amazing episode of Live from the Vault. Please keep spreading the word about this channel by hitting that like button if you haven't already done so. Share this information and also subscribe. Now, if you click on that bell, we'll notify you as each episode goes live. And with that, we'll see you next time right here on Live from the Vault. See you then.